So I will quickly give a brief intro of our three presenters. Evan Wawrick is a member of the firm. He is in our Tax and Accounting Services Department and sits in the Carlisle office. He joined SEK in 2014, 13 years of experience in public accounting, and graduated from Shippensburg in 2012 and got his master's in 2013. He is the SALT practice leader, the state and local tax department for the firm. Daryl Staley is a member of the firm. He is also in our Tax and Accounting Services Department. He sits in the York office, joined SEK in 2013, also graduated from Shippensburg in 2012, master's in 2013. Yes, they did know each other. Specializes in working with closely held businesses and individuals. And lastly, Corey Cuffley is a manager. He's in the Retirement Plan Services Department, and he sits in our Hanover office. He's a certified financial planner and qualified 401k administrator, 7 years of experience in public accounting, and over 5 as a corporate retirement plan advisor. Graduated from Bloomsburg University in 2010 and Villanova with his master's in 2011. So I will turn it over to you guys, and you can go ahead and get started. Thank you.
All right, thanks, Christina. Christina, could you go to the next slide, please? No, I'm sorry. So what we're going to do this morning is I'm going to be presenting first. We're going to give a perspective on some federal income tax planning and consideration items as the year end is coming up. Corey Cuffley is going to be going over some changes and some information related to the Secure Act 2.0 legislation. And then Daryl Staley will be wrapping it up for us with talking about some expiring tax provisions related to the Tax Cuts and Jobs Act that's currently set to expire at the end of 2025, and then as well as going over some planning tips for some business owners. Okay. So as we're coming up on year end, this is a very busy time for us as well, where we're doing a lot of year end planning with a lot of our individual and business owner clients. So one thing to think about as we're getting to this time is, from a tax planning perspective, is really trying to identify a lot of changes that are impacting your situation personally, professionally, and even going into the next year. This could be changes in marital status, changing independence, a move, starting or closing a business, or even starting to think about retiring and maybe drawing on some of your retirement income sources as well as Social Security. All those considerations can have a substantial impact to you and your family. So it's good to talk to your accountant, us, or your financial advisors before year end to discuss some of these topics. So everybody is entitled, with any individual return, you're entitled to your standard deduction. And you can see right here for 2024, your standard deduction amount is dependent upon your filing status: married, filing joint, single or separate, head of household. If you're 65 years of age or older or blind, you can see that you get a little bit of a step up in your standard deduction in addition to those amounts. Taxpayers are able to determine whether they're going to take their standard or itemized. If your itemized deductions exceed your standard deduction, you'll itemize on your tax return. Itemized deductions are a combination of medical expenses. The deductible piece that goes into figuring out whether you itemize has to exceed 7.5% of your adjusted gross income. And those expenses can't be reimbursed through an HSA or an FSA account. Right now, with the current tax legislation, we have various taxes that you're able to deduct for itemized purposes. That's limited to $10,000. If you're married, filing separate, that's $5,000. So that's looking at state, local income taxes, real estate taxes. With Daryl will touch on a little bit in his slide, but we'll see what happens if some of those legislation amounts are set to expire. Looking at interest, this is mortgage, home indebtedness interest, or investment interest. If you have home indebtedness interest, just be mindful there could be some limitations on that interest amount depending upon where your overall home indebtedness limitations are. Then also looking at charity, cash gifts made to public charities, you're able to deduct that. It's limited to 60% of your AGI. If you have charitable contributions that are in excess of that, you can carry those forward for up to 5 years. And additionally, if you contribute non-cash assets, primarily related to securities, those are limited to 30% of your adjusted gross income. So if the combination of all these amounts exceed your standard deduction, you'll itemize for your return. Since it's harder for people to get over the standard deduction amount nowadays, the two main components that get people over that hump are interest and charity now. One thing to consider as we're coming up to year end is if you're getting close to thinking about itemizing, it would be worthwhile to consider maybe bunching donations into 1 year so that you're able to benefit a little bit more from the tax year if you're getting close to that amount. Initially, donating appreciated securities, if they're held for more than 1 year, though you're able to get those deduction amounts that are component into your itemized deductions. That could also be something to consider if you are thinking about avoiding some potential capital gains, depending upon what that fair market value is. For a lot of retiree clients that I have, a lot of people who are taking required minimum distributions, a big tax planning component is doing a qualified charitable distribution. That's from an IRA. So you have to be at least 70 and a half. And for 2024, you're able to do 105,000. So that's directly taking that money from your IRA, giving it to a 501c nonprofit organization. For 2025, that's going up to 110,000. So if you do that, it's not counted as a charitable deduction for those funds, but it is able to reduce your taxable income. I have a lot of people who are in their RMD years that don't necessarily need that cash, but they have to take the money out because of those requirements. And that's just something that they wanted to consider, that they're not going to have an impact on their tax situation, but also give a gift and it's not subject to any types of other gift limitations. One also thing to consider is being mindful of maximizing your what we call above the line deductions. So this is going from your gross income to arriving at your adjusted gross income. That could be contributing to an IRA. Touch about that in a little bit here in the presentation. Student loan interest up to $2,500. There are phase out limitations depending upon where your modified AGI levels are, depending upon your filing status. Contributing to an HSA contribution. Can't contribute to an HSA if you're in Medicare. You have to be in a high deductible plan. Limits to those contributions depending upon if it's insurance for yourself or your family. Teachers on the call can deduct up to $300. And then alimony payments, if the divorce or separation agreement was enacted before December 31st, 2018, that's also a deduction if you make those payments. With tax planning, one key component is knowing what your marginal rate is. So that is knowing what the next dollar of income is going to be taxed at with your situation. That's different from what your effective tax rate is. Effective tax rate is the percentage of your taxable income paid in tax. If you have RMDs, that could be one thing to consider, where if you have to take that income, that could bump you up to the next tax bracket. So just be mindful of watching what some of those requirements are with managing what your tax liability could be. One thing I've seen coming into year end is for those who have various mutual fund investments, being mindful on what some of those mutual funds could declare in capital gain distributions. Sometimes they don't get announced or called until it's closer to year end, but sometimes the distribution amounts could have an impact on your tax situation. So here's just a snapshot of what the 2024 federal tax brackets are for single, married, filing joint, head household. Married filing separate, it's the same as single up to the 32% bracket margin. And then for married filing separate, instead of you see with single, it goes to 609,350. For separate, it goes to 365,600. So that's a big difference from single and also compared to married filing joint. The biggest thing to consider where we see a lot of impact for people is being mindful between that 24% and that 32% jump. That's the biggest hit that people are impacted by. And that's where knowing where your marginal rate comes into play with determining whether or not you're going to have that 8% difference. And then here's just a snapshot here of what the 2025 bracket amounts are. there are just various inflationary adjustments that the Fed enacted here for next year. And then here's separate and household. Okay. One thing to also keep in mind as we're coming up on year end is with those with non-qualified accounts, if you have any realized capital gains, market's done very well this year. So if you have, if you're realizing a fair amount of capital gains in your portfolio, thinking about doing some loss harvesting to maybe minimize what that impact is if you've got some investments that maybe aren't performing as well as others. If you're going to do some of that, please be mindful of wash sales. So this is a loss that is disallowed. So you're not going to be able to deduct that against your other realized capital gains. This occurs if you have a stock that sold at a loss and you have a substantially identical securities purchased within 30 days before or after that sale. Additionally, to monitoring your capital gains, be mindful of your holding period. Short-term capital gains, that's if you had that security held for less than a year, that's going to be taxed at your ordinary income rates. If you hold it for longer than a year, you get long-term capital gain rates, which is more favorable tax treatment. And here is a snapshot for 2024 of the tax rates for long-term capital gains. 0, 15, 20, depending upon your filing status. So this rates depend upon where your taxable income falls. So for example, with a person that is single, if their taxable income is less than $47,025, they have any capital gain components in that income, it's going to be taxed at 0%. And then here's a snapshot for 2025. Inflationary adjustments that the Fed does every year. We'll note I forgot to put separate here on the slide for those that are separate. 0 is the same as single up to 48,350. And then for the 15 range, instead of going up to 533, it's at 300,000. One impact that a lot of people with investment income experience with their federal returns is they could be subject to the net investment income tax. This is an additional 3.8% tax on your investment income sources. And if your AGI for married filing jointly is above 250,000, 200,000 for single or head of household, you are susceptible to this additional tax. This is separate from federal regular income tax. Examples of what could be comprised with going to the 3.8% would be if you have income from interest sources, dividends, royalties, rents, net capital gains, anything that's related to a passive investment in a trade or business. This net investment income tax is not susceptible on income from self-employment, retirement distributions, sale of a personal residence. Yes, here's our first polling question. A lot of people that contribute to a lot of tax advantage savings accounts for either their kids, their grandkids. Most common form of this is a 529 plan. One of the benefits of this plan is the earnings accumulate tax deferred. You can have qualified withdrawals from this plan, and it could be income tax free. There's no federal income, residency, or age restriction requirements on making contribution to this. And a lot of times, the amount that could be funded to these plans can be up to annual gift tax exclusion amounts, which for 2024 is $18,000 per donor per recipient. And there wouldn't be any type of gift tax return filing requirement with that amount. For those on the call that are Pennsylvania residents, the deduction for a 529 plan is determined by the taxpayer. So whether you are the owner, grandparent, it's determined by who's making that contribution to the fund. For those on the call that are Maryland residents, I'm not too familiar with some of those rules, but I do know that the max deduction is $2,500 that you can take on your Maryland return. And the account owner and beneficiary must be a Maryland resident to get that deduction on your return. So the funds from these 529 plans, they can be used for college and tuition. There's no limit on what you can withdraw from that if it's used for those sources. If you got kids that are going to elementary or secondary school that's under the college level, so private school, for example, you're able to withdraw up to $10,000 of qualified expenses per year without incurring any type of taxable event. And if you're also able to make a withdrawal from that account, a lifetime limit of $10,000 per person to go towards any student loan payments. Any unused funds are able to be passed to a family member of the beneficiary. And these funds do grow tax deferred. And as long as they're in that account, the more advantageous it can be. And Corey's going to touch on this a little bit in his slides, but one of the benefits of the Secure Act 2.0 is that unused 529 accounts can be rolled over into a Roth IRA for the beneficiary. There's some good stuff. One other thing to be mindful of is coming up on year end is looking at where, if you have an employer-sponsored plan or have an IRA, be mindful where some of those deferral amounts are to see if you have an opportunity to maybe max out or contribute up to certain limits depending upon your situation. So you can see here for 401k plans, 403bs, simple IRAs, traditional Roth IRAs, here's the contribution amounts that you're able to do if you're under 50 years of age. And there is catch-up contributions for those individuals that are over 50. And the IRS came out with the 2025 adjustments, some inflationary adjustments for the 401k, simple plan IRA limits. Traditional Roth IRA is staying the same as 2024. Be mindful, though, if you want to contribute to an IRA, you're able to make that IRA contribution for the 2024 tax year up until April 15th of 25, up to the filing deadline. And to make a contribution to IRA, there's no income restrictions to making that contribution unless you and or your spouse actively participate in an employer-sponsored plan. And note that to make that IRA contribution to a traditional or a Roth, it's based upon, you need to have earned income. So that's income from employment sources, self-employment sources, salaries, tips, wages, etc. As I mentioned, there could be some various phase-out limitations depending upon if you are able to make an IRA contribution. So that's where, for those on the call that receive a W-2, there's a box on your W-2 where there could be a box checked for retirement plan. That's why that box is there, that indicates primarily for this calculation whether some people could make a contribution with or without some restrictions. So you can see it's based upon, for a traditional IRA, there could be phase-out limitations when your modified AGI exceeds these various limits depending upon your filing status. And for the married filing joint filing statuses, those contribution limits could also depend upon who is making the contribution, whether or not the other person is covered or not covered by an employer-sponsored plan. And below, for 2024, here are the various Roth IRA contribution limits for your modified AGI. I have a lot of people, as a way to put money into a Roth if they have exceeded some of those phase-out limitations, where one opportunity is to do what's called a backdoor Roth IRA contribution. So what can happen with this is that the way to get this to be going into the Roth, making a non-taxable event, is that if you contribute a non-deductible traditional IRA into an IRA that has no balance in it, you convert that non-deductible contribution to a Roth, reported on what's called Form 8606 of your 1040, that can lead to that non-taxable event. If you have a balance in that traditional IRA and you want to do this, you got to be mindful of what's called the pro rata rule. So IRA distributions need to be taken proportionally from pre-tax and after-tax contribution sources. So if you got a mix of that into your IRA, you want to do a conversion to a Roth, the taxability is going to be taxed proportionally with your pre and post-tax percentages that's in that account. So just something to be mindful of if you want to do that strategy. Just another note about traditional IRA versus Roth IRA. If you have a traditional IRA, at some point in your life, if you get to 72, 73, if you reach that age after 2022, you have R&D requirements. Roth IRA does not have R&D requirements. Whether you're thinking about wanting to fund to either type of plan might be something to consider maybe earlier times in your life versus do you think you might have a higher rate in retirement years? Might be worth doing a Roth IRA. You think it might be lower? Could be a traditional IRA route you want to go. Just different circumstances for people depending upon which route could be more beneficial to them. I have a lot of people, especially some of the retiree clients that I serve, that are doing a lot of Roth conversions. So one area that they like to do that is what I call kind of the limbo years between when they're done working full time. They're maybe thinking about not needing to draw yet on certain retirement sources or Social Security. So their income's a lot lower. This could be a very impactful time for people to make a Roth conversion to think about what they want to leave for their heirs, think about those R&D requirements later in life. Possible way why to do this. Like I said, there's no R&D requirements with a Roth, tax-free distributions to your heirs. If you need to take out money from a Roth before age 59 and a half without incurring a 10% penalty for taking that early, you have to think about the 5-year waiting period for that. So it's after 5 years, you made that contribution to that Roth, and you're under that, you meet that requirement without incurring a penalty. And these conversions don't need to be all or nothing. That's where a lot of planning comes involved with thinking about how much you want to do maybe year over year with being mindful where your tax bracket management is. And if you do this, you are going to trigger ordinary income. So that's where being mindful of that tax bracket management comes into play. For those on the call that are withdrawing and taking Social Security, Social Security is either taxed at 0, 50, 85% of those benefits, and it depends upon where your combined income is based upon where your filing status is. Your combined income is your adjusted gross income, adding back non-taxable interest that's on your return, plus 1/2 of your Social Security benefits. That's the calculation. So if that calculation falls within these ranges, depending upon your filing status, that dictates the taxability of your benefits. Again, that's also something to play with managing your tax bracket, having good tax bracket management. Just want to highlight on just 2 credits that I have a lot of people take advantage of. First one is the Energy Efficient Home Improvement Credit. So this is a credit that is equal to 30% on certain qualified expenses. It could be various energy efficient improvement property installed within the year, home energy audits. And this is enacted up until 2023. That max credit that people could do on doing various improvements to their home could be $1,200 for energy property and certain energy efficient home improvements. There are limitations, though, on windows and doors. $2,000 for various qualified heat pumps, biomass stoves, biomass boilers. This is a non-refundable credit. There's no lifetime dollar limit to this. And these improvements have to be it must be in the US, primary residence, an existing home you improved or added to, not a new home. One of the big residential credits is the residential clean energy credit. So this is 30% credit on the cost of new qualified clean energy property to your home installed anytime between 2022 and up to 23. And then it's going to be phased out. It's going to be diluted a little bit going up to 2034. I have a lot of people that are doing this where a lot of people are thinking about doing solar panel installations. That's a big player that feeds into this credit. There are going on the IRS website can provide a lot of benefits for people to look at what specific requirements go into determining what those costs are. Has to be to your primary residence. This is a non-refundable credit, but you are allowed to carry it forward, and there's no annual or lifetime dollar limit to this, except on fuel cell property. Last thing that I wanted to touch on is if you got some people on the call that you have some income sources not covered by withholdings, you're making quarterly estimated payments, just be mindful that you want to keep up with that so that you're not incurring any type of underpayment penalty. So in order to pay into the system enough without triggering a penalty amount, You got to payment should be equal to the lower of 90% of what your 2024 tax liability is going to be, or you meet the other safe harbor threshold of paying in either 100% of what your tax liability was on the 2023 return. If your adjusted gross income was less than 150, if it's more than 150,000, you got to pay 110% of that 2023 tax liability. If you meet one of those requirements, you're protected. And if you owe less than $1,000 in tax in return, no underpayment penalty will be assessed. And with that, I'm going to turn it over to Corey.
Okay, thanks, Evan. Hi,
Hey,
everyone.
Evan, sorry to interrupt. There was one question. It says, can you touch on the income cliff for 2024 and 2025 for healthcare government credits? Healthcare.gov credits.
With that question, it might be something where I might probably have to follow up, just considering the time with them individually. But I think they might be referring to determining what the premium tax credit calculation could be, whether or not you're going to get a credit back, or you might owe some of the subsidy back. A lot of that is going to depend upon a lot of your income related factors of what you applied when you are going through the healthcare.gov to determine what your premium amounts are. So managing what a good estimate is going to be for your income situation moving forward is really going to play a factor whether or not you're going to get some subsidy back, or you're going to get into a break even standpoint, or you even potentially owe some of that subsidy back. Because a lot of those factors are going to depend upon where your income falls on the return that's being filed. But
and just to add to that, Evan, I know she referenced a cliff in the question. So it was maybe a year or two ago. It stopped being a cliff and began being a phase out. So a couple of years ago, it was like, hey, once you hit 400% of the poverty line, you had to pay all of your subsidy back. It's no longer like that. So it's not as dependent on staying under those income thresholds, and those income thresholds are dependent upon the size of your family, how many people live in your household. So it could be a very specific question for that individual. But I think, as Evan alluded to, if they want to kind of reach out, there's probably an opportunity to, find exactly what that number is. But it is very dependent, person by person and household by household.
Christina, I think you're muted if you were trying to say something there.
No, I wasn't.
Okay. I saw you lighten up. So I think we're good to proceed. It looks like there is a polling question up on the screen, though, if we want to tackle that. Okay. I'll go ahead and get started. So good morning, everybody. As Christina mentioned earlier, my name is Corey Cuffleet. I'm in the Retirement Plan Services group here at SEK. And today we wanted to just touch on a little bit of the Secure 2.0 Act. This was a significant piece of legislation that took effect a few years ago, and it was actually preceded by Secure 1.0 a few years prior. And essentially, what the government was doing here was they're recognizing that there's a retirement crisis in our country, and folks are not necessarily prepared for those retirement years. So what essentially both acts are trying to do is increase accessibility to plans, allow people to save and start to build that piece of their retirement plan out. So the Secure Act 2.0, what we wanted to do here today is we wanted to talk about some of the provisions. Hopefully by now, again, the law was signed into effect in December of 2022. So hopefully by now you've heard a lot about this. I know we have a good mixture probably of business owners and individuals on the call today. So certainly the business owners, hopefully you've been made aware of a lot of these provisions. And then from an individual standpoint, hopefully you're getting this information as well from various sources. But you can see here, there's kind of a range of effective dates of these different provisions. So there are some that are currently in effect, and then there's some that are coming down the pike here. And what we're going to do in the next couple slides is we're going to take you through, what is in effect now, excuse me, and what's going to be in effect here in the future. The other piece to this is there are a lot of provisions. We're not going to touch on every single one of them, and the ones we are going to touch on, I'm going to try to keep them as high level as possible. But some of them are actually optional, and some of them are mandatory. So I'll try to point those out as we go along. Certainly, if you're a business owner and some of these provisions sound interesting to you and something you'd want to offer in your plan, please do inquire of your third-party administrator on your retirement plan to see what makes the most sense for your company. And from an individual standpoint, if you hear something that you think really applies to you, what you'll want to do is work with or talk to your employer to make sure that these are available. Because again, many of them are actually optional, so plans don't have to necessarily offer them, but they could. And another point on that, more so from the business owner standpoint, depending on these provisions, your record keeper provider for your retirement plan may not be fully ready to handle them either. So you do want to inquire of your record keeping platform as to whether they are even set up to handle some of these different provisions. And then I just have the last bullet there. Although that some of these provisions are in effect now, there's no official amendment that needs to happen to a plan document, adoption agreement for your plan until 2026. So really between now and 2026, when those are due, it's just kind of keeping track of, okay, what provisions are we doing and what are we not doing? So when that 2026 timeframe comes along, you'll be prepared. Christine, next slide. Okay, so again, what we're going to do is we're just going to start through some of these provisions. We're going to start with what's available now and then work towards what's coming in the future years. Excuse me. And it's going to kind of bounce back and forth between business owner topics and individual topics, although certainly all of these is going to be from an individual standpoint. So for first bullet point here, I wanted to mention required minimum distributions. I know Evan alluded to that a little bit in his presentation, but once you reach a certain age, which now is age 73, you're required to take a certain portion of your retirement accounts out each year and pay tax on those amounts. Those are called required minimum distributions. And historically, the penalty for not taking those in a timely manner was pretty substantial. So it was actually 50% of the RMD that you were supposed to take is the excise tax. Part of Secure 2.0 is they actually reduced that from 50% to 25%. And there's a note here. It says with a possible penalty of reduced to 10% if corrected timely. And the timely correction that's referenced in a lot of the IRS materials is corrected within 2 years. But it is interesting. It does say possible penalty reduction. So it's certainly something, if you can avoid any penalty, certainly want to take those on time. Just as a quick reminder, your first RMD is due by April 1st, following the year they're required, and then December 31st every year after. So penalty reduction there is kind of the first step in Secure 2.0. Additional IRA catch-ups for over the age of 50. Again, once you reach age 50, you actually are able to contribute additional contributions to 401k plans and IRAs. That has historically, for an IRA, the individual retirement account, has always been kind of stagnant at $1,000. That is indexed for inflation now. So interestingly enough, the 2025 limit was still $1,000, but it is indexed for inflation. So presumably into the future, we'll see that additional catch-up increase as well. Now we'll jump into some of the provisions that are going to be applicable to retirement plans specifically. 401k plans. So qualified student loan match. So this is something I'm sure a lot of you have heard stuff about. It's been in the news. And I mean, student loan debt in particular is talked about pretty frequently. The student loan matching program is something that was a concept that was actually, it had come out before the Secure Act, but on a very limited basis. And Secure Act made it available to more and more employers, virtually anybody who's interested. But the concept with this student loan match is, you may have employees within your company that can't contribute to your retirement plan because they just have so much student loan debt they can't afford to also put money into your plan. And if your plan offers a match, well, they're missing out on additional contributions that they could have to their retirement plan. So what this allows employers to do, if they so choose, you'll notice it does say optional there. It's not something employers have to institute, but they can, is we can, or the employers rather, can take into account the fact that, hey, you are paying your student loans. So we're essentially going to treat those as if you were putting into the plan so that we can contribute the match, because otherwise we couldn't give you a matching contribution. So this is going to allow employers and employees to have money into the plan. Certainly some challenges with that in terms of verifying student loan payments are made and so forth. So there's a lot of hesitancy, I would say, broadly speaking, to adoption, but it is something that's available. Employers can do that currently. Next slide. Okay. Employer contributions permitted to be in Roth. So again, this is probably something that you've heard of. I seem to be getting more and more questions about it. So traditionally, employers, when they put money into your retirement accounts, that has always been a pre-tax contribution. So the employer gets a tax deduction, and then the employee, when they take that money out later on in life, they'll pay taxes on that money. Secure Act now allows employers to offer employees the ability to make their employer contributions Roth as well. So many plans these days allow you to save Roth. This actually will allow you to elect your employer money to be put into Roth as well. It's an optional provision. Employers do not have to allow for it. I do have a note here to watch. So one thing that certainly concerns me from our standpoint of this is, we are talking about Roth contributions. Roth contributions are not tax deductible today. So you are paying tax on that money today. The concept is it grows over your lifetime and you get to take the balance out tax-free, including earnings, when you retire. So the employer still gets tax deductions for those contributions. 1099s will be issued for employees that elect to do this. And if it's available to them, they will presumably be getting 1099s at the end of the year to say, hey, here's income that you have to pay tax on for the current year. So it's just something to keep in mind. Certainly if you're sitting there thinking, yes, I would love to have more Roth money, just be cognizant of that, because that could come up and get you at tax time. 529, the Roth IRAs. I know Evan again mentioned this in his piece earlier. So part of Secure Act 2.0 is to allow for unused 529 funds to be rolled directly into Roth IRAs in the name of the beneficiary. So not the account holder or owner of the 529, it's the beneficiary of the 529. You are able to roll unused money over into the Roth IRA for that beneficiary. There's a couple notes here. In order to do this, the 529 had to have been maintained for at least 15 years. So it can't be a fresh new 529 plan. It's got to be one that's been around for a while. The annual limits mirror the IRA limits. So in terms of the money that you roll over to the IRA, it's sort of treated like a Roth contribution. So you're limited to the, I believe, $7,000 for the Roth IRA limit per year, up to a maximum of $35,000 for that beneficiary. So new option, effective now. We do get, I believe 2023 was actually the first that was allowed for. So 2024 is certainly something that people are looking at doing. Secure 2.0 eliminated Roth accounts from the RMD requirement. So an interesting tidbit that not many people know, because one of the benefits to a Roth IRA is people know that you don't have to take RMDs from that. One interesting point was, prior to this, Roth accounts in your 401k were subject to RMDs. So you still had to factor those amounts into your RMD amount and balance, but that has gone away. So now they are more similar to the Roth IRAs. Employee self-certification of hardship withdrawals. So hardship withdrawals themselves are optional. So 401k plans can allow you to take, in the event of a financial hardship, money out of your plan early. One of the requirements, though, for employers historically has been they had to gather proof that you are experiencing a hardship. So you're about to be evicted from your home. You have a lot of medical expenses and so forth. They were required to gather that data. That is no longer the case. If an employer elects, they can say, we're just going to allow employees to self-certify, sign a form saying that they are indeed under a hardship, and move forward. So that is a new feature that I think is getting pretty well accepted amongst employers, but not everyone. But just wanted to make everyone aware. Here are three, the birth and adoption is just kind of enhanced a little bit, but three additional distribution options available. Again, all optional. So if any of these would relate to you and you're an individual, you do want to check with your employer to see if they are offered in your plan. But the idea here is that if you take a distribution from a retirement plan before age 59 and a half, typically you are subject to a 10% early withdrawal penalty. These particular distributions you see here are exempt from the 10% early withdrawal penalty. And again, they are all optional. So things like qualified birth and adoption. So you can take up to $5,000 from a plan in the year that you have a child or adopt a child. Domestic abuse withdrawals, same thing. If you are a victim of domestic abuse, you can withdraw. You can see here it's the lesser of $10,000 or 50% of your account balance. And terminal illness, again, a penalty-free withdrawal. If you are subject, if you have a terminal illness, you do need a physician's certification on that one. And on a morbid note, it's you have to expect death within 84 months. Is kind of the term surrounding that one. An additional distribution option available here to avoid any kind of penalty is kind of this emergency expense withdrawal. Again, optional provision. You do want to check and make sure it's available. But effectively, it's kind of like, and really both of these are kind of like little savings accounts that are available within retirement plans now for participants. So the emergency expense withdrawal, certainly if something pressing comes up in your personal life and you need to withdraw, you can take the lesser of $1,000 or your vested benefit per year to help with that. The pension-linked emergency savings accounts, or PLESAs, as you'll hear them often referred to, another optional provision, but that is very much so like a savings account that could be offered within a retirement plan. So if you just want effectively a Roth balance within your 401k account where you can tap into it as you need to, this is an option as well. Again, from our standpoint at SEK, we typically advise against these two options just because, with the retirement account, we do want to make sure that it's set up for retirement, but certainly these offer the ability to tap into that money if you are running into a significant circumstance in your personal life. Touch on these very briefly, but changes to simple IRAs. So if you're a company and you've had a simple IRA, traditionally, if you wanted to move to a 401k, you had to do that at the end of the year. 2024 was the first year in which you can actually switch to a 401k mid-year as long as you are moving to a safe harbor 401k. There are some limitations with that in terms of the contribution limits and so forth, having to prorate those, but it is possible. Simples are also allowed to offer Roth contributions. So one of the drawbacks to simple IRAs and SEPs historically they've always been pre-tax contributions for the employees. You can now actually allow for employees to save Roth in those as well, provided your provider of that plan is set up to do that. And with Simples, they also have a 10% higher deferral rate now. So if you are a company that has fewer than 26 eligible employees, this is automatic. So this is available to your employees. If you are between 26 and 100, they can elect to allow these. And if you do, you have to actually increase the employer contribution. So just a little nuance there. But you can see it's 10% higher than what the standard deferral rate is so you can see 17.6 and 38.5. That's 10% above what the normal rate is. Next slide. Another polling question popped up there. Number 3. I think that is my cue to probably speed up a little bit. So I will fly through these credits. My main, the main objective here of these next 2 slides is really just to make everyone aware of these, particularly the business owners. So part of Secure 1.0 and Secure 2.0 is to try to encourage employers to offer plans. So the startup cost credit for starting up a plan. This was one that's been around, but it was enhanced. So previously you could write off up to 50% of your cost of starting a plan, up to $5,000. That credit increased with Secure 2.0 to 100%. So 100% of your costs up to $5,000. There's a calculation that goes into effect here you can see $250 times the number of non-highly comped employees. So again, don't want to get too far in the weeds with that, but just know you do have a credit available if you started a plan in the past few years. Keep that in mind and bring that up at tax time to review. Number two there, this is a big one. This one's new with Secure 2.0. It's actually an employer contribution credit. So if you're an employer that contributes money to your employees' accounts, this is a credit that's available that you can actually you get a credit for the money you're already putting into your employees' accounts. So there's some specifics to it. It only applies to employees earning less than $100,000 in FICA wages, and it's a 5-year credit that phases out over the course of 5 years. So again, it's worth a look if you are a newer plan within that 5-year period. As we sit here today, and you contribute money to your employees' accounts, it's something to look at tax time to see if you have that available to you. Last two credits: automatic enrollment credit, easy. If you have automatic enrollment in your plan, and it's the first 3 years of the plan, you get $500 per year as a credit. Military spouse, I'm not going to get into very much. It's a little complex, but just know if you are an employer that has a military spouses on payroll, you may have the ability to claim a credit potentially for that. But there's a lot of some stipulations to that you have to look into. So just keep that in mind if it applies to you. Long-term part-time, this is a concept that has been around for a few years now, but 2024 was actually the first year that long-term part-time employees came into play, and that is actually changing for 2025. So that's why I have both years up there. So the concept behind a long-term part-time employee is if you have an employee that's worked for you for at least 3 years, consecutive years, and they've worked at least 500 hours, in 2024, you were required to allow them to enter your plan for deferral purposes only. So you were required to let them save their own money. They weren't eligible for employer money, but they could still save their own money. And 2024 was really the first year for that, because prior to 2021, we could exclude service. That is going from 3 years to 2 years beginning in 2025. So in 2025, anyone who had 2 consecutive years of 500 hours worked needs to be able to save their own money into the plan. So just be cognizant of that if you're an employer and have employees, but that one's been around for a little bit. New in 2025, automatic enrollment mandate. So if you started a plan after December 29th of 2022. So a relatively newer plan. By January 1st of this coming year, your plan needs to have automatic enrollment. So any employees that become eligible, they would automatically get put into the plan. There's some specifics here in terms of what that has to be. If your automatic enrollment is less than 10%, it has to have an auto escalate feature to get the employees to 10%. It must also include a permissible withdrawal period. So if an employee accidentally, or forgot to opt out of the automatic enrollment, they need 90 days to be able to pull that money back. There's a couple exceptions. Again, anybody who started their plan before December 29th of 2022, you do not have to have automatic enrollment. If you're a younger business, so if the business itself is less than 3 years old, that is exempt as well. Small businesses with 10 employees or less are exempt. Once you hit 11 employees, you have a 1-year grace period to get that automatic enrollment feature in place, and church and government plans. And the question does come up sometimes in terms of when you started your plan. It is when you signed the documents to start your plan. So if your plan was effective 1/1 of 23, but you signed it in early December of 2022, that does exempt you from the the automatic enrollment mandate. Higher catch-up limits. This is an optional feature starting just this year in 2025. So ages 60 to 63, you actually get a bump in what you're able to save. The increased limit is the greater of $10,000 or 50% more than the regular catch-up limit. So it's always typically going to be 50% more than the regular catch-up limit. Interesting to note, that begins the year you turn 60, you are eligible for that additional catch-up. The year you turn 64, even if you were obviously 63 for part of the year, it's the year you turn 64, that reverts back to normal. So it is that you no longer have that increased catch-up. So it's just that brief period of time. It's an optional feature, so you do confirm with your employers. Last bullet, the retirement lost and savings lost and found. This is something I haven't heard much about recently, but part of Secure 2.0 was to establish lost and found. So sort of like an unclaimed property where you would be able to go and see if you had an old 401k from an old plan. So that or from an old employer. So that is something that should be getting pretty close to ready. I haven't heard many updates about that, unfortunately, but that is a part of Secure Act as a mandate. Catch-up contributions in Roth. This was something that was actually slated to already be in effect, but it was very complex for payroll companies to handle. So it actually did get bumped back. You'll see it's not mandatory until 2026, but it is mandatory. So this is something where employees with FICA wages equal or exceed 145,000. If you are going to do catch-up contributions, so you're trying to maximize your deferrals, the catch-up portion of that is going to need to be in Roth. So certainly if your plan does not allow Roth, that does need to be amended. Next slide. And this is the very last one, I promise. So 2027, for those of you who don't know, depending on your income level, if you were saving into a retirement plan and your income level was below a certain threshold, you actually get a credit on your tax return for the fact that you are saving for retirement. That is changing in 2027 to a match. Very interesting to see how this plays out, but it is going to be a match that the government is actually going to fund based on how much you are saving into your IRA. So not going to get too much into that one. I think there's still a lot to be ironed out there, but that is coming down the pike in 2027. So that is all I had. And if there's any questions that came through.
Or there's one in the chat. You might be able to answer that just by chatting if you see that.
So, yep. So I see that. Can you tell me again when the catch-up contributions have to be put into the Roth? So I think what we're talking about is that one of the second to last slide there. So, catch-up contributions, that is 2026. So beginning in 2026, and that is only for people who make more than $145,000. So that is not just for everybody. So if you're below that threshold, you can still do your normal catch-ups, but it's just for those over 145. And I'm sorry, I did miss an earlier question there on the student loan contribution. Our payroll providers saying they aren't able to do this yet. Does this seem their system? And I think we've seen that at least from others. So we've seen that from, again, there's so many of these different provisions and so many of these providers are trying to catch up. So there are certainly ones that aren't able to accommodate that now. So I'm not sure which provider that is. And I couldn't tell you when they would be able to, but we've certainly seen some. Now, again, it is for the student loan piece, it is a match. So there may be a workaround in terms of, it's not something that necessarily has to run through payroll. I could technically be calculated outside of payroll and submit the match separately for those individuals. There's also services that are available that, because one of the things I mentioned was it's difficult to verify, has your employee been paying on their student loans? Do they even have student loans? Are they just saying that? So there are services that can actually link into their student loans to confirm, yes, they are paying on their student loans. They are true student loans. And that can go towards, calculating what that match is. So for the payroll piece, I can't speak to that very much so, but certainly the record keepers have been in varying degrees of what they're willing to do. Yep, you're welcome.
Good morning, everyone. I'm going to chat a little bit about a few things, one being the current tax rates or current tax provisions that are set to expire in 2026. Although very uniquely enough, we know that our new president is the same one who put these provisions into place. So do we know that they'll be extended? Maybe. Probably more likely than it was, a month and a half ago. But I think we have to kind of operate with what we know. And if I had a crystal ball and knew what they were going to do, I probably wouldn't be sitting here. But to talk about, what's going to happen come 2026, we would expect that we'll revert back to pre-2017 tax rates. You can see those rates there on your screen. Generally, you can see that those rates are a little bit higher. So, and even the brackets are a little bit smaller. So what was formerly maybe a 24% tax will now be taxed at 28%. So just something to keep in mind. A lot of times what we've been doing for clients is actually been having them accelerate income, which is kind of atypical of what we do as tax planners. Usually we're trying to, push income into the future and defer it. But with these rise in tax rates on the horizon, that's kind of what we've been talking about. Although there's maybe a little bit more of an unknown now, or an idea that the rates that we currently have will stay. The standard deduction amounts will also be halved and adjusted for inflation. So right now, generally speaking, that standard deduction for a married couple is about $28,000. That will drop down to 14. So that as well actually would cause an increase in tax. That SALT deduction that Evan also spoke about currently has a $10,000 cap that would go away. For those business owners, business or bonus depreciation will phase out after 2026. So this year, 2024, we're currently sitting at 60% bonus depreciation. That phases out, basically 20% a year until it goes away. And then the pass-through entities will no longer be able to deduct 20% of qualified income. So there's something known as the QBID, which maybe you guys heard, which basically says if you have $100,000 of business income, you're only taxed on 80,000 of that. That would be set to expire. At this point, it's a wait and see game. But we'll see what happens. Although my expectation is there won't be any changes or extensions of these current provisions until 2026. I don't know if there's any, legislators in the room, but generally I think that they won't do anything until they have to do something, and they don't have to do something until, that time period comes. So we'll see these things phase out, and we'll see what happens come 2026. Child tax credit will be reduced. The phase out thresholds, the income limits there will drop as well. A common thing here is the estate and gift tax. So currently you could die with $5 million, or currently you could die with about $13.5 million per person, or $27 million per married couple, and not have to worry about paying estate tax, which is a pretty significant tax. If that reverts back to the pre-2017 levels, you're talking about $7 million per person. So we were doing a lot of gifting, working with estate attorneys to do a lot of gifting, estate planning, which included gifting assets to heirs or others, in an effort to get below and take advantage of the thresholds we have. I've since seen some of that kind of slow down just because they think these things will continue to extend. But again, something to certainly talk to your professional about if you have assets, above really that $7 million threshold as an individual, or 14 as a married couple. Paid family and medical leave credit. This will expire. So, a lot of things are set to expire and go away that were actually pretty favorable to taxpayers. So I would just keep that in mind. I did see a question there about the $2,500 de minimis. I don't believe that's set to expire. So you're kind of safe with that. But next I'll jump into some quick planning tips, that are sort of basic. I don't want to go into too much detail. And I think you have to be mindful to always consult with your advisor, because just because they fall on the screen doesn't mean they're the right thing to do for you. But kind of retracts what I said earlier, but about accelerating business deductions. It just depends what rates you're going to be in the future, kind of trying to look at that and, see where you are going to be in, 2026 versus where you are today. But generally speaking, a lot of people will try to get expenses into this year. And that way they lower their tax that they'll have to pay, come April 15th. Another common strategy, if you have a small business, have your kids do some work in your business. You can put them on payroll. likely they're going to be in a lower federal tax bracket than you are. And the first $14,000 roughly is exempt from federal income taxes. So I pay my son to work in my business. The first $14,000 I pay him is really tax free. And I may have moved it out of the 24 tax percent bracket into a 0% tax bracket. The other potential idea is that that income paid to your child might be exempt from Social Security and Medicare taxes. That's not the case always, but if you have a sole proprietorship, it can be. And then, what I tell some of my clients is like the Roth IRA. So my son's on payroll now, for example, and I open up a Roth IRA for him, and he contributes, $5,000 into his Roth IRA. So the $5,000 that I paid him was never taxed. He puts it into a Roth IRA today, and in 20 years, or really 60 years, that Roth $5,000 in the Roth IRA grows to $100,000, for example, and he gets $100,000 that he gets to pull out in retirement, all tax free. So a common strategy that you can see wealth build up for your children. And my guess for a lot of us is we are giving money to our kids anyway. So for the work that they're doing in your business, put them on payroll. Have on here leverage and HRA. They've been around for a little while, but I've seen increasing popularity with them. It's a health reimbursement account. It's different from an HSA, which you might have heard of, but as an employer, you can put money into an HRA account for your employees. And then the employees basically submit their medical expenses and pull money out of that account. But it's a deduction for you. The money that you put into the HRA is tax deductible. So you basically get a tax deduction on your medical expenses. Quick note on retirement plan contributions. Employee money would be due by the end of the year. So if you're an employee and you want to maximize your contributions, make sure you get it all in there before December 31st. Employer money, so any matching, things of that nature, would be due by the due date of the return, including an extension. Couple other things. If you're using a personal vehicle in your business, don't forget to log your miles. A common deduction that is missed. There's also that home office deduction. So if you're using a portion of your home, if you don't have a place to go, if you can't go into an office and you work from home, you can take advantage of the home office deduction. That home office should be used exclusively for your business. So, if you set up shop in your kitchen, it's not really eligible for a deduction. But if you have a room dedicated space to where you work in your business, it can be. That is if you're self-employed. So if you are a W-2 employee and you work from home, you do not get that same benefit. Again, the Augusta rule, you can rent out your home tax-free for 14 days. So, of course, you could rent it out to somebody who's looking for a place to stay. You could Airbnb your home for 14 days and the income would be tax-free. But also you could rent your home to your business, right? Your business could conduct board meetings in that space. And so the business pays you. It's a tax deduction in the business. You don't have to pick it up as income if you allow your business to use a portion of your home, but it has to be for less than 14 days. I spend a lot of my time working in real estate and working with those in real estate. So this is one that I enjoy, but don't just look at this and think it applies to everybody. But purchasing a short-term rental has some opportunities to take advantage of to create some losses, perhaps on your return when paired with a cost segregation study. So that might be very high level. But if you were maybe on the fence about buying a rental property, I would encourage you to reach out to myself or your advisor about what you would need to do to make that work to help offset some income. Also, something you can do here before year end: purchase a vehicle, use it for 100% business. If it's greater than 6,000 pounds of gross vehicle weight rating, that allows for the most optimal depreciation. But a lot of times, that's a way to incur a big expense for something you need in your business. health insurance. So if you are an owner of an S Corp and your business, your S Corp pays for your health insurance, just a reminder, for that to be deductible, it needs to show up on your W-2. Far often see that is not the case. So make sure you're talking to your payroll providers. And if you're paying for your own health insurance out of your business. Another quick tip, obtain your required W-9s. 1099 season is kind of upon us. So make sure you're getting W-9s from your subcontractors and things like that, so you can get their EIN or their socials and issue those 1099s. The BOI reporting, it is new for 2024. I suspect that any business owner on this call probably has to complete it. I will say that if we have been advised by our insurance carrier that as accountants, as CPAs, we should not be preparing that, as it can be seen as practicing law, which we are not licensed to do. So I would encourage you to communicate with your attorney if you haven't done that yet. And then, lastly, you could do it on your own. I will honestly say it's not an overly difficult process. Many people are equipped to handle it. But if you have any uncertainty, reach out to your attorney. And as I said in a few spots, consult with your CPA. These are tax planning tips that are, high level, sort of broad and vague. And while I think they're great, they're valuable, they may not be for everybody. You should really be talking to somebody who fully understands your situation and can walk you through these items. So I knew I was quick there, but I wanted to get through a lot of those things and be respectful of everybody's time. There's a few things on here, be mindful this time of year. It's, notorious for scams, whether it's IRS scams or people looking for donations. It's the season for giving, right? But we don't want to be giving to putting our money in the hands of the wrong people. So there's a couple of notes on there. The IRS will typically not call you. Or excuse me, they will not email you. So be mindful of that. A lot of their communications will come via mail. So just be hesitant. Ask somebody, ask us, hey, what do you see is going around? There's a ton of scams that we see floating out there, and we don't want you guys to be victim to those. So I think as Evan alluded to, review your personal situation for any changes, review your portfolio, review your estate plan, discuss any questions with your financial advisor and accountant. We are professionals. You guys either have us as your professionals or, somebody else. We are here to be leaned upon. The best relationships are the ones where there's a lot of communication. So, share with us that information and we can make, great decisions together, and maximize savings and minimize taxes and unknowns. So we will open up to some Q&A, but our contact information is there if you want us to elaborate on anything that we shared. Feel free to reach out, touch base. And we'll be happy to get back to you. Christina did say that the slides will be made available as well. And then I did see on the BOI thing, there's an injunction by the Texas court. I have heard about that. I think there was something similar in Alabama or in Arkansas as well, but I don't know that went through, and it might end up being state specific. I will say I think the penalties are pretty hefty for not filing those. So I would encourage you. It honestly takes about 10 to 15 minutes to do it in a very simplistic business structure. I would encourage you guys to get those done this year. And if we don't have to do them moving forward, hooray. But I don't think you want to be dealing with the substantial penalties that come along with not doing those. So fingers crossed, those things will get repealed and we won't have to do them. But I would encourage people to take that step.